performed. But let's take stock of what's really happening with the markets and what really is the strategy going forward. We have with us Vinod Karki, the head of strategy at ICICI Securities, joining in. Vinod, hi, good morning. Good to have you on the show. I was just going through your last note wherein you have a nifty target at 17,800. Given how swiftly we've made it to 17,400 as of yesterday, Vinod, are you already reworking on your price targets?
Yeah. So good morning, Farida. That's a very good question. See, basically, we have been telling this also that, as the clarity on the economy is improving, as people are getting more confident on the economic recovery, they are willing to, settle for lower and lower returns going forward. Because as you know, historically, if you see, the best returns are only made when there is a lot of uncertainty on the economic front, on corporate profitability, on everything basically. When the volatility is high, when the uncertainty is high. Now people are getting more and more confident. So that's what is resulting in investors actually asking for lower and lower returns, even if it is so long as they are positive basically. So we are entering this phase where you will get positive returns because the economic environment is improving. You are seeing corporate profitability improve, but you will have to settle with lower and lower returns, especially given that the liquidity also will start getting a little tighter. The way it has moved the other way, that direction will be reversed at some point in time. So valuation expansion will no longer drive equity valuation, the stock prices. It will be largely the growth element which will drive it. Yeah, so you will see lower and lower expected return as the certainty increases. That's how the math works. Once you get certainty, you don't get outsized return anyways, basically.
Okay, but do you believe that another 400 points of a move and the index would hit a ceiling?
No. So see, these are fundamental targets. Basically, markets always move in extremes. That's been always the case. So if optimism really rises, that's a certainty that these targets, fundamental targets that you derive from data, they get overshot because optimism. That's what history has taught us, that you move from one extreme of pessimism to the other extreme of optimism. So if you have a fundamental target data, it will be overshot if the optimism really rises, right? So that's not what I'm saying. It can overshoot, but given where the earnings are and where the multiples are, fundamentally the upsides are lower. Nevertheless, they are positive, So that's the base case scenario right now. And what we also wrote in the report, which was more interesting, was that on valuations, basically you have the two approaches. Either you look at the asset approach or the income approach. What we are observing is that on the asset approach, which is the price to book ratio, we are not at the highest point as on the income approach, basically, which is the price to earning ratio. So on the price to earning ratio, there is absolutely no question. In fact, we were just looking at which month of 2007 we are closer to. We are closer to the November 2007 levels on the PE basis. But if you look at the price to book basis, we are somewhere in the 2005 era, basically, in that whole bull run that we saw from 2002-03 to 2008, right? And that price to book is largely the case because we are at almost a 2-decade low return on equity for the Nifty 50, basically at around 12%, which is expected to go to 15%. But you have to remember that the potential ROE of India Inc.
Right. Okay. Now I completely understand that fundamentally this market has reached its headroom, but markets could overshoot. So what should an investor do? Because the investor is saying that if I'm buying right now, I'm buying a market where you cannot justify it fundamentally. But if I sell now, I perhaps miss the best part, which is the euphoric move where maximum money is made.
Yeah, absolutely. So you cannot turn the clock back. I mean, the guys who stuck through all that uncertainty will benefit disproportionately. People who are safe bet, who play safe, have waited for the economic numbers to really show up and now are getting into the market. Obviously, they should expect much lower returns. But the point is, are we going to see a drawdown or slow, up moves? So the scenario looks like that. Given the improving profitability of India Inc., which is moved from 10% ROE in 2020, currently 12% expected in 2023 to reach 15%, and has the potential to reach around 29-30% that we saw in 2008, the trend is upwards basically. What the market has done is that it has discounted some of that future returns a little early, so which will cap the returns in the short term, but it takes away the scenario of a large drawdown, which typically happens which we saw in 2011-12, where the ROE dropped from the 28-29 levels to 15%, and the GDP started collapsing. It was the weakest point in the last, pre-COVID, where for 2 years the average GDP was around 5%, right? And the profitability of companies fell off. And the investment rate also peaked out somewhere in 10-11 So we are not in that scenario. If you look at the GDP numbers, the GDP is led by gross fixed capital formation and net exports driven by global demand. And the return on equity the profitability of companies are improving, right? So you have to worry about whether you are sitting in a scenario where economic growth can collapse, which typically results in large drawdowns in the market. That doesn't seem to be the case right now. You will have to only settle with lower returns, basically positive returns.
Okay. One simple answer which everybody gives me when I say that why markets have gone higher, the answer is liquidity. But frankly, if I look at the month of August, liquidity was not that high. FIs were selling, DIs were buying, and liquidity at best in a market when IPOs were on was neutral for the secondary market. Yet markets, they surprised us. So do you think it would be unfair to say that markets are going higher only because of liquidity?
Absolutely. I mean, if you just do a back test, what happened during taper tantrum? So February this year, we saw the first yield spike in the US, and it resulted in a very you won't say a meaningful correction in the markets globally, right? I mean, without, direct taper tantrum, the market was already reflecting a big spike in US yields, which is a reflection of that liquidity will no longer be the incremental driver of valuation, right? And interest rates also will not be the incremental driver of so that was a time, that was a litmus test for the market when the yields first spike, both on the expectation that inflation will be higher and also that at some point liquidity will go out, basically. Which the Jackson Hole, it was very clear that it was like announcement of the US taper tantrum, but there was absolutely, I didn't see any massive volatility in the equity markets. So it is absolutely clear that liquidity is and no longer will be the incremental driver of equity markets. It has to be only growth and the return on equity from markets, which will drive the corporate profitability, which will drive earnings. That's our clear belief that liquidity and interest rates will no longer incrementally lead to markets rising. They may at best sustain it, but the US Fed has already signaled that the tapering will happen, basically. And the way US economy is expected to grow, 21, 22, you're talking about 6% average growth. When have you heard of US expected to grow at almost 6%, which is like an emerging market kind of a growth, basically? So obviously the interest rates will normalize and liquidity will go down basically. It's growth now, I think, which is driving equity markets more than anything else.
Right, interesting. So I'm just going through, Vinod, some of your top ideas, and that includes the likes of an Inox, a TCI Express, Hindustan Aeronautics. But let's talk about these companies one by one. Why a Hindustan Aeronautics? I know it's a recent entrant into the F&O segment, but that aside, what makes you so bullish on this space?
Yeah, so these are our, I am a strategist, and these are some of our top picks from our individual sector analysts. But typically we are seeing, some of these companies seeing demand, basically, especially, on defense side, we are seeing government budgets go up, basically. So all these companies are where we have, what we are seeing in the economy, just like what happened during if you see the 2003 to 2008 era, basically, the GDP expansion was led by the investment rate rising. If you see the Q4 GDP and now the Q1 FY22 GDP, it is very clear that it's investment rate which is rising, right? And net exports through manufacturing for the global economy, that's driving the demand. While consumption, services, PFC, that's the, the slower part of the economy. So I think that's why our topics reflect that wherever it is driven by government spending, infrastructure development, capex, the new age economies, some of the lockdown companies which will open up, so all those things, and where the valuations, if you see on the income front, as I was saying earlier, there is another distortion which has happened apart from the low ROE and low PAT to GDP from which we are rising, is that the low volatility, high ROE stocks cannot have further re-rating on valuation. They are absolutely at the top. But at the same time, tell me one bull market where a section of the market was much below their long-term average, basically, on valuation. There is a segment of the market, we have shown it in the report, that where the valuations are below average, below the long-term averages, if you see. So that doesn't happen in the bull market. See, bull market is all out. All the assets listed, they are at the peak in terms of the standard deviation, the Z-scores, compared to their past, basically. So I don't see that. There is a polarization, if you may say, that a lot of stocks are still below average. We just look at the price to book. 46% of the NSE 200, largely in the capital intensive sectors, are below zero price to book, basically. So it doesn't, it's a lopsided market which is self-correcting, I think, where the value stocks are getting re-rated. Some of the investment side of the economy stocks are getting re-rated. While I don't think the consumption will disappear, the only thing is they are so expensive that they may just chug along. They may just give those few percentage returns. They are not going to collapse or something like that. But the outperformance is clearly coming from the investment side of the economy, the cyclical side of the economy. That's clearly visible. So that's what the topics that we have given reflects, basically. Largely the investment side of the economy.
So basically, the low volatility, high ROE stocks, they have been priced to perfection. There's no more room for the valuations over there to increase. But the capital intensive guys, the ones whose price to book is actually in the negative, watch out for those. I think that's largely the understanding. Vinod, thank you so much for taking our time and joining us today, sharing with us what your India investing strategy will be from here on. Thank you so much once again.
It was a pleasure. Thank you so much.
Okay, well, I think on that note, we're going to have to take a very short break.